Hello, everyone, and welcome to this new meeting of the Finance Network series titled In Conversation, Exploring the Philosophy of Money and Finance. And today we are very delighted to welcome Chris Cowton from University of Huddersfield, who will be interviewed by Lisa Wareski from CUNY Graduate Center and University of Connecticut, who is a pillar of the Finance Network. Thanks again, Chris, for accepting our invitation, and of course, Lisa, for conducting the interview. And today's interview is titled Truth in Financial Accounting, and it's inspired by a chapter authored by Chris in the recently published volume, The Philosophy of Money and Finance, edited by Jürgen Sandberg and Lisa Wareski, and published by Oxford University Press. And following the interview, we will open the floor for discussion as usual. And if you like to ask a question, please raise your virtual hand using the Zoom menu, and I will moderate the queue. And that's all from me for now. And let's begin the interview and enjoy it.
Okay, well, thank you, Emiliano. I'm really pleased to present Chris Cowton, our guest today. And Chris has had a long and distinguished career. I'm just going to be able to mention a few highlights here. He joined the University of Huddersfield as a professor of accounting in 1996. He served as dean of the business school from 2008 through 2016, and then as professor of financial ethics, 2016-2019. His prior appointments include lectureships at the University of Oxford and Cardiff. Upon becoming emeritus professor at Huddersfield in 2019, he served as associate director of the London-based Institute of Business Ethics through 2023. Now, Chris has published extensively on a wide range of topics in finance and accounting, and these encompass conceptual argumentation, quantitative and qualitative empirical research, mathematical analysis, and historical work. In 2013, he was awarded the University of Huddersfield's first ever Doctor of Letters in recognition of his original and significant contribution to the advancement of knowledge in business and financial ethics. Chris was recently elected Fellow of the Academy of Social Sciences, that would be last year, 2025. He was also a recipient of the British Accounting and Finance Association's Lifetime Achievement Award in 2023 for his substantial and direct contribution to UK academic accounting and finance over the course of his career. I'm very pleased to welcome him here today on finance. And before I get into questions about the chapter, I'm curious, and Chris, I'd like you to maybe tell us a little bit about your background, more than what I said. How did you come to be interested in business ethics and more generally philosophy?
Well, thank you, Lisa. Thank you for that introduction. Lovely to see you as part of this. Well, I've been around a long time, as I think you were saying, and things accrue, don't they, if you hang around long enough. It's nearer 50 than 40 years since I held my first academic post, and as you indicated, those posts had largely been in accounting rather than in ethics or philosophy. Interesting, I think that the next but one book chapter I wrote after the one you and Joachim asked me to write, which we're talking about today, was on the development of research and teaching in business ethics in Europe. And I wrote the UK chapter. I also co-edited the book, which is why my chapter got in, probably. And I wrote it as an autoethnography. So asking me about the development of my career is kind of fresh in my mind as I waded through nearly 50 years of diaries to try and base what I was writing on some facts. So my first point was back in 1980 in accounting in Aberystwyth, and my first research project was on the disclosure of charitable donations by companies, and that was funded by something called the PD Leak Trust, which is an accounting body. But of course, it got me into something looking a bit ethicsy. So I was interested in disclosure, but there I was looking at corporate donations. And because that hadn't been looked at in the UK before, I did some background work on that practice, which led to my first paper in Journal of Business Ethics. So the E word then pops up on my CV all of a sudden. And the next bundle of work I did was around what we then called ethical investment, socially responsible investment, maybe you'd say ESG investment. A lot of the issues are the same as we've been debating for for decades now. And that involved being a social scientist, it involved quantitative empirical work and qualitative empirical work, but also because it was early in the writing on that subject, there's a bit of ground clearing to be done, which I did with 5 questions, one of which was, is it ethical? Which brackets, in what sense could it be seen to be ethical? And so that got me into more philosophical stuff. And I published a piece in Ruth Chadwick's Encyclopedia of Applied Ethics, which you might know. I also got to know Joachim Sandberg when he was a PhD student, who questioned me about my work at a conference, which he seemed to know a lot better than I did. And actually, we co-authored the subsequent edition of that. So I'm starting to meet philosophers and publish in philosophical outputs. And I also met when I was in Oxford, got to know Roger Crisp, who many people will know as professor of moral philosophy there. And I was thinking about ethical investment, and we were chatting, I think, on a plane back from the US originally, a strange trip we were sent on by the vice chancellor of the university. And I said, well, in what sense could ethical investment be seen as an attempt to avoid hypocrisy? So we got involved in talking about hypocrisy and published a paper in American Philosophical Quarterly back in 1994. So now I'm publishing in philosophy. Who'd have thought it? And subsequent projects in the finance area have been on banking and trade credit. But I thought, well, actually, my main area is accounting. What about ethics and accounting, which are kind of left to one side? And then I was asked to give a lecture, the PD Leak lecture in 2007 at Chartered Accountants Hall in London, because I wanted someone to speak about ethics for a change at this annual lecture. And that led me to start thinking more seriously and systematically about accounting ethics. So we're getting close to the chapter now. I actually grounded it in my take on the sociology of professions, which I won't bore you with now, but it led to things such as being invited to join their ethics standards committee and the desire to do more work on accounting ethics. So Hugh LaFollette asked me to do an entry in his International Encyclopedia of Ethics, excuse me. And as well as drawing on some work I'd done on virtue ethics and accounting, I thought about, well, a lot of people are concerned about whether accounting's truthful or not. And so I started to jot down some thoughts which have been really in my mind ever since 1980 when I first started teaching accounting theory. And so that's how I really got into the ethics and philosophy kind of stuff. And I edited a journal for 10 years, Business Ethics European Review, and got to know a lot of the American business ethicists as well. So I thought, well, maybe I should study philosophy properly. So I did a graduate diploma in philosophy at York, but I wouldn't call myself a philosopher, but a little education hopefully goes a long way.
Okay, great. Thank you. It's just by way of starting to set the stage here, could you say why there's a problem about truth in accounting? Why was this something of some urgency that you felt you should take up?
Well, it's really the debates. I mean, we all remember, well, some of us remember Enron. Of course, it's 25 years ago. So our students, it's before undergraduates, if I were teaching them, it's before they were born. But there have been so many so-called scandals about accounting and about whether the numbers are saying what you would expect them to say or what they should have said with hindsight. And those problems are not often downright lying. I mean, anyone can put false numbers into accounting systems, but this was much more to do with, in a sense, choices that people had and the questions of manipulation. So as Catherine Whitehorn, the respected journalist, once said, with creative accounting, as we call it, who needs cheating? You've got a lot of scope for coming out with particularly the profit figure that you want, which might fit nicely in with your bonuses or your banking covenants and various things like that. So that was, if you like, there's a problem. But as those debates, public debates go on, I've always been conscious, well, what do they think right accounting would be, or accurate accounting, or truthful accounting? And do they think there is a true profit figure, for example? And maybe if challenged on it, they wouldn't, but yet they talk as if there is a true profit figure from which the reported profits, and there are other numbers disclosed as well, of course, but profit is kind of like the par excellence case for us to think about. There's a range of profits one can come up with from any given set of data. So there isn't a true profit. I don't think a single profit figure out there from which the published figures have deviated, but there's almost an implication sometimes that there is. And even accountants will talk about that somehow they're saying something about reality, and they use words like that. They talk about measuring. So although that when push comes to shove, if you really work through with them, what's the nature of what they're doing, they probably acknowledge, well, it's not really about what people think it's about. But actually, accountants can also be quite naive about what is the nature of the numbers that they are producing. So that's number one problem. I think that's the main problem, that there's some worry out there about the truthfulness of what's going on in financial reports. But I think it's based on a real concern, but probably a wrong conception of what we're doing here. There is then, I think, a subsidiary problem, which is an academic problem, which is that I think some academics will be aware of accounting theory still and know the nature of the numbers, but some of them also, I think, the more critical end of things, in a sense, partly because of the level of argumentation that they engage in, almost dismiss accounting. So there's one or two very influential papers on the social construction of accounting, which I'm quite happy with. But the implication sometimes is that anything goes. And that's also not true. So while there's no single profit figure, it's not true that I can generate, I can pretend that, my local corner shop is making $1 billion profit a year. So somewhere in between there's appropriate figures, but what are they related to? In what sense can any of those figures be thought to be truthful? And I say some of these thoughts are sometimes explicit from the academics or in the policy debate, and sometimes they're kind of hanging in the air.
Yeah.
So I think that's why there's a problem to be thought about when it comes to truth and accounting.
Yeah, good. So you begin your chapter with a question, and I'll state it now and we'll come back to it. In what sense or senses, if any, can accounting statements be said to be true? So this is the question you take up in your chapter. And again, by way of setting the stage, could you please briefly introduce the three philosophical theories of truth that you consider in the chapter by way of answering the question?
Well, we've established I'm not a philosopher, so this is going to be a bit rough and ready, but I do argue that for the purpose of the chapter's argument, I can only really do some rough and ready. So there's a lot of placeholding going on here, rough caricature or rough characterization of three approaches to truth, within which there are myriad strands, and some indications of where they might or might not take us. So I think it's well accepted by philosophers that, if you like, the everyday conception of truth that people hold is the correspondence theory, that statements say something about the way the world is. So they're in some sense world relating. So that common sense view is very apparent in debates on accounting. I think partly because people don't have necessarily any other view of truth. So this is all about the hanging in the air, even if it's not being made manifest. So I had a little bit of a think about correspondence theory, because that was the most obvious one to think about. I tried to avoid debates on facts, but I suppose there's a lot of debate about correspondence theory and critique, and we'll come on to some of the responses to critique. I understand also this kind of neo-correspondence theory, so it's been making kind of a comeback in philosophy in a way. But I suppose my concern was that, as it often is with philosophers, is that there's an awful lot of talk about tables and black swans and goodness knows what, but there's not much talk about the kind of things that interest me, which might be profits and finance and things like that. So I guess that sometimes the discussion of correspondence theory, and particularly in the context of philosophy of science, slightly misses where my interests are. But I think what we can say about accounting, if we're going to use correspondence theory, then accounting would be in some sense picturing the world or representing the world. And as we've already established, that's problematic. Now, some people find correspondence theory is just problematic in themselves, and they might head down the coherence theory route. It's often a reaction to correspondence because we can't quite commit to that. So what can we work on? And rather than a relationship of a statement to the world, I guess it's coherence theory is about the relationship of statement to statement. So what we're interested here is does a given statement about some state of affairs cohere with a wider set of statements, perhaps ones to which we're already committed. So it's sort of a consistency kind of approach. So if the metaphor for correspondence was picturing, this is more like dovetailing, I guess, is how I'd characterize it. And even for I think for a correspondence theorist might see coherence as being necessary but not sufficient. And of course, the big problem with a lot of empirical stuff, or talking about the world, is that although coherence theories can be quite useful, you could argue there's that feeling for anyone who's not an out and out, I don't know, idealist or something like that, that somehow you need something somewhere that's world related to kick the whole thing off. But that's a much more technical discussion. So, but it's a statement to statement consistency type approach. And then the third bucket or box of theories that I looked at was pragmatist. And I struggled here a bit to characterize pragmatist theories. I'm not the only one, but let's let them come to the party, and their presence will prove to be welcome, I think, as we go through this. But if we take the idea of a basic idea of pragmatism, I know there's the different strands of person, yes, Dewey or whatever, James, that true statements are a good basis for action. I don't think anyone would necessarily disagree with that, although actually what is true doesn't always lead to the best outcomes. So there's kind of a problem at that starting point. But all this is a bit crude. I mean, Peirce, I think, so as I understand him on science, has this kind of idea of, the truth, the good way of doing knowledge creation, scientific, is taking us towards the truth rather than away from it. But I mean, that seems a bit too mystical, or at least helping yourself to a correspondence theory of truth at the same time. But other people are far more expert on these things than I are. But what I took really from the pragmatism, and what I labeled on the pragmatism box, was theories in a sense, or theories of truth are essentially concerned with what works. And other elements of what other people might see as being truth would be good. I mean, it'd be nice if things dovetailed, and nice if they corresponded to the world in some way. But it's maybe a bit less precious about things than a pure coherentist or correspondence argument. So that's my very crude depiction of the boxes. It's really looking for the difference between them rather than any more than a basic essence or family resemblance amongst them. Within those boxes, different theories might lead us in different directions. But I'm hoping that if I use those as a placeholder in my argument, that if someone says, yeah, I can kind of see that there's something useful in talking about accounting through this theory of truth, I can run my own particular version of that theory through it and see where we get to.
Okay, good. Just a couple of things as you're, setting this up in your paper. You do want to clarify for the reader two essential concepts to accounting. One is double entry bookkeeping. The other is accrual accounting. If you could just maybe briefly summarize those two, because I think it's important to bear those in mind as you're thinking through.
Operative word, doing my best to be brief.
I know it's hard, but
yeah. Okay. So, I mean, these are fundamental to contemporary accounting. There's lots of different ways of doing accounting historically and theoretically. So I won't go into all those kind of things, but underlying stuff we've got. So modern accounting going back a few centuries for big enterprises being based on double entry. So double entry is a way of basically recording transactions. Now, you can just record transactions on a bit of paper. You might occasionally see neater ones where there's two columns. Just because there's two columns, that's not double entry bookkeeping. That's just bilateral form. So double entry bookkeeping is that for every transaction, there is an equivalent amount of debit and credit through the way in which the accounting system is set up. I won't explain how that happens, but it's quite an elegant system. The thing with it is it provides you with a check. So if when you take all the balances out of the books of accounts and wrote them all down on a piece of paper, your total debits did not equal your total credits, you've got an error somewhere. Something has gone wrong. So it's kind of like but balancing the double entry is necessary, but not sufficient for the double entry necessarily being accurate. I mean, you might have failed to put a transaction in at all, or you might have two compensating errors. So, but it is a useful check. on the integrity of the data on transactions, which we'll come back to, that you've recorded in the system. So that's double entry. Is that enough on double entry?
I think so, yeah.
Yeah, I think so. It's probably all we need. So then accruals accounting. Well, the crucial thing about accruals accounting is to know that just because you've got a profit doesn't mean you've got any money. That's the starting point. So you might think it's all about cash. Well, it isn't. So if I take a very simple example, which I actually did out for my students in Oxford originally, but I've used for MBA students and all sorts. Imagine you're selling cans of pop drink on the high in Oxford on a hot day to tourists. So you buy, and you've got £10 in your pocket, and you go and buy 10 cans of drink for £1 each, and you sell them for £2 each. Nice markup. But you sell 5 on the first day. So basically in your pocket, you've got 5 times £2. You've got £10 in your pocket. So you haven't made any progress over the day. Your cash hasn't changed, has it? But you might say to yourself, well, hang on a minute. I've got 5 cans I can sell tomorrow. So I'm level on cash, but I'm up on cans. So you can see how cash differs from. And the great thing about accounting, accruals accounting, is it brings all those different assets and indeed liabilities onto a common dimension. So the question then arises, well, if I was trying to come up with a single number to summarize the performance of the day, I need to value the cans. And that is literally a can of worms, not a can of drink. We generally value them at cost at the end of the financial period, but supposing you drop them all and they got bent and you can only sell them for 50 pence, you'd have to value them now at 50 pence, say. So there's lower of cost and net realizable value. And there's all sorts of shenanigans about what the cans are worth. And of course, the other example I use in the book, a much more extended one, I use a retail one, but I then have a taxi firm, which has a kind of a pedigree in accounting theory. And supposing you bought a taxi for $40,000, well, your cash outflow in that period is going to be really negative. But do you cry about that? Well, no, because the taxi is a fixed asset, as we call it, which doesn't mean it can't move. The taxi is a fixed asset you're going to use in future periods. So you start saying, well, actually, bit of mental accounting. I kind of used up part of the taxi this period, so I need to take part of its cost. But to do that, it's a very, very complicated theoretical area. Basically, you need to know the cost of the taxi. You need to know what you might sell it for, because you might sell it while it's still working. So that gives you the net cost of the taxi. You've got to decide how long it's going to last until that point of sale. And then you've got to work out a depreciation method, of which there are many. So these 2 examples, I think, bring us to 2 fundamental things about accruals accounting. Well, 3. It differs from simple cash surplus for good reason. I mean, it's important to understand cash flow, but you're trying to make a more rounded judgment on performance. There's different accounting methods you can use. So 2 enterprises might be identical in all respects, but the accountant chooses a different depreciation method, which in the period concerned will lead to a different profit with no change in what happened in the world. And the other thing that is really interesting, I think, which I don't push hard in the chapter because it's not the argument, part of the argument, but to account for the past year, the past day, in my first example, you need to make assumptions about the future, which is really weird. And so I have to take the taxi, I have to make assumptions about, I know the cost, but how long will I keep it for? What will it be then worth? I don't know. I might be wrong. In the case of the cans, will I be able to sell them tomorrow at least cost? Well, I don't know yet because I haven't done it, but I've got to put a value in now. So for these 2 kinds of reasons, different accountants could come to the same set of transactions data and come up with different profits in a given period for perfectly legitimate, subjective but professional judgment reasons.
Okay, good. This kind of leads very well into my next question. I think a lot of people do have a picture of accounting as representing reality in this kind of naive way. And yet, as you just illustrated, there's a lot of judgment on the part of the accountant who's preparing the statements that enters in. And you can't just, describe these facts in front of you. You have to, make some judgments about how to present the information. And as you just said, you have to make assumptions about the future. And this is how you can have differences in this kind of way. So where does that leave the correspondence theory then, as you understand it, vis-a-vis accounting?
Well, I use a little illustration in the chapter about civil engineering, and I might be not even civil engineering, but there's a civil engineer goes along to check on a bridge and makes various measures and comes back, and you're not quite confident whether their judgment is sound, so you send someone else to go out and do the same thing. Um, and they will use the professional methods, and are likely, if they're both doing it professionally, they'll come back with the same numbers, to the minutest of tolerances, they get their ruler out or their tape measure or their, whatever it is. And in the case of something like profit and quite a lot of other accounting things, I'll call them things for want of a better word, there's nothing to go and look at. So in a sense, accountants don't measure profit. They use the word measurement, and they use the ideas of measurement error, and they have measurement in some of their professional conceptual framework. But I think when it comes to profit, they're not measuring profit in any normal sense of the word. They're calculating profit. The bridge precedes the measurement, whereas the profit precedes the measurement or the calculation precedes the profit. Until you've done your calculations, you have no profit.
Oh, yeah. And this raises the question then, if accountants are in a sense constructing the world,
hence the social constructionist.
What constrains the construction?
Yeah, absolutely. But I think that can be, I say, my secondary worry was I think some of the academics overplay that, or just kind of think, well, let's give up on talking what better or worse accounting might be in terms of truth. Into critical theories, they just worry about power, essentially, and they don't think about what is better or worse mainstream accounting, because that's not their bag. But I do think sometimes they just go too far, leaving it in the air that anything will do. But of course, it is a problem that there isn't anything for these numbers to correspond to. So that's where our problem is really with the correspondence theory, except let's go back to double entry bookkeeping and the basic thing that we start out with transactions in accounting. So we buy a taxi. Now, how we then treat that is another matter. But if you like, that's a kind of an anchoring, a world relative anchoring to the accounts. Now, it's all sorts of magic happens in the detail, but fundamentally, that gives you some sort of anchor point, even if your ship can move quite a lot in one direction or another from those anchor points. And some, there are professional judgments to be made around methods and how you apply them, and sometimes they're pushing their luck a bit. And we've tried to, over the past 50 years, reduce the variety in practice. But some of the variety in practice is useful or necessary because there's no one obvious best method in advance for a particular situation for accounting for a particular thing. You could say just give it all up and just account for it in cash, but then I go back to my can example and say, but that doesn't really tell us about performance. It tells us about something, but not performance. So there is some correspondence element there, I think, which is at the root of the system. But above that, we're really constructing a set of accounts from the transaction data. There's the books of accounts, but then the published financial data is very much constructed from those. So there is some correspondence at work in a traditional accounting system, but the end numbers that you see in the financial report, many of them are not corresponding to something in the world. Some are, for example, the total of money you owe to trade creditors should equal the money you owe to trade creditors. So that is something where there is correspondence. But I'm particularly interested in profit as kind of being, because it's such a residual term where any other shenanigans or strangeness goes into that figure. I think that's the one and it's the most important figure for people to think about. That's the one I really focused on in the chapter, and that's what people usually have in mind. But there are some figures which are more world relative than others, but fundamentally it's transactions data. And I mentioned in the chapter this 1958 paper by Elizabeth Anscombe called On Brute Facts, which some people might know. I don't know how on earth I came to read this years ago. It's a good accountant. But anyway, of course, she uses examples of the money she owes her butcher. So I was really pleased that kind of basic transaction data was for her a good example of a brute fact. So there's a bit of correspondence. in part of accounting, in an aspect of accounting.
Now, as I was looking over your chapter in preparation for the interview, I had the impression that the role of coherence is really well, if we see that two numbers don't cohere, that they're inconsistent, then we know that there's something wrong, there's an adjustment to be made. And I was wondering if the role of coherence might be something more than that. Perhaps there's a kind of harmony that one, finds as one is preparing the statements. So it's not just that if there's an inconsistency, we make an adjustment, but is there any kind of harmony that plays a role, do you think?
Yes, I think that's a fair point. And in a sense, I was trying to show when things might go wrong. But yes, I think there is a harmony in the whole kind of accounting equation of debits and credits, of assets equals liabilities plus equity, which I haven't gone into in the chapter, but there is a coherent system there which can pull apart, or it can be, or if it can be done well, is one more simple way of putting it. But yes, there is a harmony, a coherence to the accounting equation.
Okay.
As well as
turning now to the rather messy business of the pragmatic theory.
Yeah.
It's tricky because there are so many different strands. But one thing you point out is that the accounting boards, IASB and FASB, are interested or concerned with what accounting is for. So they are looking at the use, and perhaps we're thinking about the users of the financial statements. What are those users going to do with them? What are their needs? And could you just maybe say a little about how you see this playing a role and what some of the challenges?
Well, I mean, it's interesting to take a step back, but yes, it is about really, is accounting useful rather than what accounting is. And it's very interesting to see that kind of, if you'd asked an accountant quite a few decades ago what good accounting is, they would have talked in terms of the technical characteristics, the debit and the credit, the accounting equation, not making mistakes and things like that, not pushing your luck on the judgments you've got about accounting methods. And there was a turn in the 1960s and 70s, really, towards this user approach, which can be conceived of in various ways, and there's various flavors of it. It's a nice parallel, I think, with other fields, though. So, for example, around about in the early 80s, I was talking to someone who works in librarianship, became a professor of a lot of such stuff. And, keeping the books, because they keep books as well, was all about, well, originally chaining them up so people couldn't steal them, but then it was about cataloging, Dewey, Library of Congress, whatever, making sure they're in the right place on the shelves, they're catalogued correctly and all that kind of stuff. So it's about looking after the books. And there was a kind of a turn, which we saw even in the renaming of some libraries into information centres in universities, although it's turn back to say what are libraries there for? They provide information and support learning or whatever. So there's that kind of user turn in librarianship studies as well. And so that was very much what was there in accounting, expressed in various ways. Now, whether that was a change in the rhetoric and whether that really fed through into the practice is a moot point. But yes, certainly changes to accounting were mobilized in the said interests of users, particularly capital market users, but it could be others as well, particularly creditors, say. And that was, there's a resonance there, I think, with certain flavors of pragmatism. It's a what works kind of thing. And so you do see resonances there. And I don't think they're just spurious ones. I think there's something you can do with that kind of thinking. So in a sense, I think there's different bits of the truth theories, or the truth theories potentially shed light on what it means for accounting to be true. Now, if you only like one of those theories, then look at the way, correspondence, I've explained how that could be relevant, coherence and pragmatism. On the other hand, if you're a little bit more pluralist, I haven't set out deliberately a pluralist position here. I've just kind of said, well, let's go with the three and see where we get to. But I think what you can see is that I think there is some resonance between the different truth theories and aspects of accounting, but none of which would take it all the way, which I think is what I think is an important point. But it means you can't just dismiss correspondence, but nor should you naively hold on to it, and similarly with the others. So accounting numbers like profit cannot be true in the sense of correspondence theory, but resonances with correspondence, the kind of kicking off of the process, as I put it in coherence theory, is there in accounting. Coherentist, as you've rightly pointed out, I could have said more about, also has something to say about good accounting and truthful accounting, and pragmatist accounts can have something to say about accounting. And we see all that in some features of discussion of accounting. And of course, those, if you work through them, they all might have implications, which I don't do in the chapter because it was long enough already, in terms of criteria for more truthful accounting, which I don't use the word truthful. I avoided that. It's something I might want to look at another time. So I think that's where I end up with the chapter. All of these have something to say, potentially, if you accept them. In terms of pluralism, truth pluralism, though, alethic pluralism, it made me wonder about that philosophically. So the way I understand it is that truth pluralism would usually be, treating different kinds of subject matter differently in terms of truth, which fits with my idea of it's not all about tables and black swans. This background is largely social science. So that I think that applies, but it's usually in relation to a particular discourse.
Right.
So if you're talking about ethics, or you're talking about social science, or you're talking about this, or you're talking about science, if you're doing natural science, this is what truth looks like or consists in, or the approach you should take. And one of the things that I reflected on at the end of this is, well, I've looked at one discourse, which is accounting, and I can sort of see something that all these types of truth can say something about in terms of better and worse accounting, and more truthful and less truthful accounting. So philosophically, I don't know if that's a very profound point, but it's just something that struck me. One discourse on all three versions of truth have something to say.
Yeah, great. Okay, I think we should end here and turn it over to questions from the audience.
Yeah,
So,
thank you very much, Chris and Lisa, for this stimulating interview. And so we can now open the discussion. And if there are questions, if you are willing to ask questions, please raise your virtual hand on the Zoom menu. Otherwise, I have a question just to break the ice. Yes. So my question is this one, Chris, and I'm trying to push in the non-representational line you were mentioning. So the idea that accounting is not simply a kind of representation. And so I was wondering if there is a way of considering accounting as a way of intervention in reality, in the sense that I'm not saying by cooking the book, which is, of course, it's a different aim, but since it involves, accounting judgment about future, and you can have several ways of assessing the future. Probably there is a way by which accounting can create some kind of future. And so in this sense, I don't know if it's clear and it makes sense, but
I think it's interesting. So one of the things I think that came along with the user turn, which I alluded to when saying that pragmatism might be some resonances with pragmatism, is of course people saying, well, are people actually using accounting? And if they are using accounting and making decisions with it, which was very much the focus of how people conceived of the use of accounting, which I don't think is the whole picture. But particularly, going back to Ball and Brown's study in the 1960s, was looking at is there a reaction in the stock market to the release of accounting numbers, and lots of other ways of thinking about the impact of accounting too. And maybe there was less reaction than people thought, but I think there clearly is use of accounting to make decisions. But it also has effect in terms of disclosure. So it's a nice concept which Prakash and Rappaport came up with in the 1970s, I think 77, I think, which was that the very process of having to disclose information changes behavior. maybe in anticipation of what users may or may not do with it, may be wrong, may be right, but they call that an information inductance effect. So it's not just about users, it's also about disclosures. You know, if we have to tell people what we're doing, we probably change what we're doing, don't we, in everyday life. So there's that element of it, but there's also some very simple and basic ones in accounting. So we have this idea that to make estimates or come up with the figures when we're doing the annual accounts, we have to make assumptions about whether it's a future prediction, whether the entity is a going concern. Because if it's not a going concern, the liquidation of value of the assets will be a lot less than what is shown in the book of accounts. You have to revalue to the lower of cost and net realizable value, so it's down to net realizable value. So you might say, well, as an auditor, I'm not, or as a director, hopefully, because you have to ask yourself if it's a going concern, you might think, well, maybe it's not a going concern. So to be err on the side of caution, conservatism, which is an accounting principle, prudence and all that, we might say, we're not sure it's a going concern. It's not bankrupt yet. It's not gone bust. But as soon as you say it might not be a going concern, you've got to revalue all the assets. And of course, in no time at all, just the statement that we're not sure it's a going concern is no one's going to extend you any more credit. Creditors are going to want to bail out. People will leave. So actually, it could be a self-fulfilling prophecy. Even if you were wrong about it, if you hadn't said anything, maybe it would have been a going concern. So yes, I think there are very real effects. And of course, accounting numbers find themselves in all sorts of different contexts, used for different reasons. So famously, Mrs. Thatcher, when she was closing down the coal mines in the 1980s, and I grew up in a coal mining area in the north of England, she said, when challenged about it, she said it's mirrors. So she basically thought, the numbers just reflect the reality. That's what she was saying. Now, it may have been a good economic decision, socially problematic, but a good economic decision to close coal mines, as it turned out. But it wasn't the individual coal mine profitability wasn't really, well, actually, it wasn't measured very well, to be honest, anyway, from a technical point of view. But she thought it's just facts. And remember, she was a chemist. She'd done chemistry.
Thank you very much.
Yeah.
That's a very interesting answer. We have a question from the audience, from John Welch. So thank you, John.
Yes, Chris, I want to thank you for the presentation, which I found very interesting. And I should say, I'd like to turn on my camera, but it's not working. So it's not from a desire to hide my face. But I do have a question about a comment that you made early in the talk. You said that it's quite possible that two accountants would work from the same set of data and come out with different reports in ways that are not dishonest. They're simply using different criteria at certain points of their analysis. And if I remember right, the example that you gave was different methods of depreciation. At least you mentioned that at one.
Yeah.
Different methods of calculating depreciation. And I was wondering if you might provide another example, as concrete as possible, of how two accountants might start from the same set of data and come up with different pictures of what they're reporting on.
Yeah. Okay. Good point, John. Plenty of examples, I'm sure, and trying to think of a good one. So let's go to some fairly fundamental things. My can example was very simple in terms of getting money, but many times in business, particularly business to business work, you are working on long-term contracts. And the question is, when do you recognize the revenue and particularly the profit that arises from a contract? So you're doing a lot of work this year. The stage payments are one thing, but of course there's retentions as well. So some accountants would, and this is a major area of where things go wrong or in scandals often, is revenue and profit recognition. But there are conventions, but different accountants might make different assumptions about what is the appropriate profiling of the anticipated profits. So you've done some work on the contract, so it seems sensible to recognize some profits. 5-year contract. Why don't we recognize a fifth of the profit if it's an equal amount of work each year. Well, of course, things might not turn out as you planned, but that's again predicting the future. So revenue recognition and profit recognition is a major area. Accounting for financial instruments that can change state in the future depending on the state of the world. So convertibles and things that can go from equity to debt or can be security. Yeah, all the magic stuff that all the finance guys come up with, which many of those who contributed to the book as well would know far more about than I do. Exactly what that you should call them is really difficult at this moment because they can change their state. It's not exactly quantum physics, but it's got a nasty sort of uncertainty around what it is you're even looking at when it can become something else. So that would be another area which affects some businesses more than others. I mean, just stock is another one as well. You know, well, how much is the stock worth? There's an implicit assumption about the future that it's worth at least what it's carried in the books, but that might turn out not to be true. One accountant might say, this stock is slow moving, I'm going to write it down. Another accountant might think it's slow moving, but that's not unusual. I'll carry it at cost still. So there's just lots of areas in accounting where there's legitimate choice, not just about the method of accounting, but particularly it's this thinking about the future aspect that really bedevils it all and can become a self-fulfilling prophecy as well, as I said. Does that help, John?
That's very helpful. Thank you very much.
Nice to hear from you, even if we don't see you.
Okay. So I don't know if there are other questions coming from the audience. I mean, you, Lisa.
Yeah, I can't find my online hand to raise. This is maybe a follow-up to this, but I'm just wondering if you could say a little bit about how accountants value intangibles. This has always been puzzling to me. So trying to come up with the value of a trademark, say the Coca-Cola trademark. I mean, it just seems, I'm wondering what some of the constraints are there, because that certainly looks like an area where, you know, not anything goes, but it would be hard to have.
Yeah. Well, traditionally, something like a trademark or goodwill on acquisition of a company where you're buying a lot of intangible, you know, it's revenue generating possibilities rather than just its machinery, was called goodwill.
Mm-hmm.
And in a sense, it only got into the accounts when you paid for it, when you acquired it. So it was a transaction, goes back to this transaction thing. Now, you may have overpaid for it, winner's curse and all that. You know, these things are in play. You bid the most and you're the person who loses because you win the auction or the implicit auction. But that's what it will go in the books at. And then you do an impairment review, which again is a major area of problem. You know, when you see the regulators' problems with accounts that they review, so not the auditors, but the regulators, you know, revenue recognition is one, which I just mentioned to John. Impairment reviews is another, and on what basis you do. So is this asset still worth at least what you paid for it, and should you be writing it off and all that? So it's a nightmare. Then I think in the 1980s, if I remember rightly, people started putting self-generated intangible assets on the balance sheet, and that came out from a particular set of circumstances, and particularly in this country, the UK, the takeover of Rowntree, the chocolate and sweet firm, by Nestle, where it was felt that, rightly or wrongly, that Nestle got it at a very good price because, in a sense, the balance sheet, which doesn't tell you the value of a business, it's not intended to do that, was somehow not reflecting all the worth of this company. So then when you actually have to value such an asset, a trademark or something, there are methods. And of course, in a sense, you do that in a company when you think about taking someone over. So it's not like it was just totally foreign. But yes, you're thinking about superior revenue streams and discounting back and stuff like that. And but it is an area of great subjectivity because it's essentially there's not a transaction to look at. And some people just rule it out. It doesn't fit with the whole classical historical cost transaction-based accounting, but that has moved in so many ways to put, you know, replacement values on balance sheets sometimes, and current values and mark to market is another thing rather than cost. So in a sense, the edifice is creaking. So classically, it would have been straightforward. It's only on if you acquire it. But then there are all these kind of adjustments to the accounting system, which partially overcome some of the limitations, the incompleteness or out of dateness of the classical system. But it's a very partial thing. There are theories of accounting which would do away with that and start from somewhere else. But yeah, good question. I think that's my take on that. But it's doable. There are established methodologies which you can then audit the assumptions, for example.
Okay. So thank you again, Chris, for this answer. And I don't know if there are other questions from the audience. I don't see questions. So I think we can stop here, and thanking again Chris for his wonderful interview, and of course Lisa for his help in conducting the interview. And I hope to see you soon on the next online finance seminars.
Well, thank you also from me, Emiliano, for setting all this up, all the work you do, and for the invitation today. And thank you to Lisa for being such a lovely interviewer, and also for the opportunity to write my chapter for the book, which gave me a good chance to get down on paper and think through some issues which have been in the back of my mind since about 1980 when I first taught the accounting stuff. So thank you for that.
Yeah, it's a real addition to the book. We're really pleased to have it.
Thank you.